Okay, good evening, guys. So welcome to the second TRG for FM. Like I mentioned last week, what we will be doing this week is basically three constructed response questions. So three section C based questions. One will be from investment appraisal, one will be from risk management, the other one will be from cost of capital. Okay. So as much as possible, I'm trying to cover certain questions where, a majority of the syllabus is examined. So I'm choosing questions where we have a lot of your syllabus, different areas being examined. So that way, now in 4 TRGs, 4 times 3, we would have done 12 questions. Hopefully, we have covered all areas of the syllabus. Okay. The other thing is, yeah, so this is the second week. So we have 3 more TRGs, including today. But in addition to this, please make it a point to, on your own itself, try to complete the MCQs and the MTQs. Okay, because we have at no point in this TRG, we have gone through MCQs and MTQs. Reason being that MCQs, MTQs, if I do, I can just talk about that particular question, right? But I can't really cover the syllabus as such. So that's why I am focusing on the constructed response. But if you can do the constructed response questions, then MCQs, MTQs should be a little easier. Okay, because it will only be a portion of the constructed response. So if constructed response is for 10 marks, then and there are 5 steps, then in an MCQ, they would just test one of those steps because you only can give 2 marks each. Okay. Right. So let's start off today with a question based on risk management. So the name of the question is, I think it was Plum Company. Let me just check. Yeah, Plum Company. Okay, so that is page 178 on your revision kit, on the Kaplan revision kit. Okay, so let's look for that. 170. Yeah, 178. Okay. Yeah, so this one, it's March 16. It's the last question actually in your revision kit. It's about how you can hedge interest rate risk. Okay. So last week we did a question called Nedwan. Yeah, Nedwan Company, where we had foreign currency risk. Okay, so let me explain what this risk management is at the beginning itself, right? What, according to financial management, risk simply means variability of return. Okay, meaning you're forecasting something, but that is not actually happening. What actually happens is not the forecast. So variability in the return. So that is risk. Okay. Now for a company, risk can happen due to different factors, right? You can have business risk. For example, if you're a company that is, focusing on selling, let's say, books or exams, let's say your Kaplan, for example. Okay. Then naturally, now every book has it has like an expiry date, no? Okay, so the maximum you can go up to for a book is, let's say, September 2003 to September 2004. Sorry, 2023 to 2024. Okay, only 1 year you can use a book. Reason is that the syllabus changes. For example, tax syllabus is like that. So now, naturally, for Kaplan, when it comes to like, maybe June, July, August, those months, they will see a drop in the sales of their tax books, because people will not be willing to invest in the book because they know that it's only going to be valid for 3 months. They will think like, okay, let's do another paper and then come back and do tax when the rates have changed. Yeah. So now what I'm trying to say is that kind of a risk is called a business risk. Okay. Meaning in the nature of the business itself, everybody who is in the industry, they will face that risk. Okay. So now that kind of business risk, to some extent, we can forecast. Okay. Now we know that based on our past experience, in August, it will drop. Okay. So what we are forecasting also, we will forecast it in such a way that August, the sales we have predicted is actually less. Okay. But there are two types of risks where it is not so easy to forecast. One is foreign exchange risk. Why? Because it's difficult to forecast the exchange rate at a future date, because we can't control that, right? We, based on past experience, exchange rate doesn't change. No, that that changes based on many factors, market conditions, not in our control. So One way we have to figure out, now we can't say forecast properly, because no matter how well you forecast, chances are that on the day that you're actually converting the currency, there will be a variation, because no matter how good a forecaster you are, there is only some extent to which we can forecast an exchange rate. So one way we can do, I mean, we can reduce the risk is going into things like forwards, yeah, going into things like currency futures, currency options. Those are different, it's like basically instruments that you can use to hedge the foreign exchange risk. So hedge is what? Hedge means reduce. So last week we spoke about how we can reduce the foreign exchange risk. Now this week we are going to talk about interest rate risk. So what is this risk? There are two types of risk when it comes to interest rate. One is, there are two types of loans. Okay. Some loans, they have a fixed interest. Okay. And some, they have something called floating interest. So fixed interest means if they say, okay, it's a 10% loan, then the interest is going to be 10% of the principal and it's fixed. It never changes. So there is no risk there. Floating means they will say, based on the market, based on the interest rates in the market, the amount that you have to pay to the bank, it will keep on changing. That is called a floating rate. So the moment the interest rate is floating, automatically we have a problem because we won't be able to properly forecast. We will see variations. Okay. So now this floating problem, we can solve it by going for a fixed rate loan. If that is a problem for us, we can just go ahead and go for a fixed rate loan. But there is another problem. And that is, let's say for example, we are in the month of February. Okay. Now, based on our cash forecast, based on what we have forecasted for the year, we realize that in the month of September, okay, now this is February, I'm talking about September. In 2024, September, we realize that we have a cash deficit. Okay, for some reason, okay, there could be many reasons for that. But for some reason, we are going to have a cash deficit. We know that today itself, we know it because we have forecasted well. So now as a business, what will we try to do? We will try to, in September, try to take a loan. Okay, we'll try to take a loan because only if we take a loan, will we be able to manage our finances, because we're having a cash deficit now. So we don't want to be in a position where, we can't pay our suppliers, we can't pay interest. We don't want to be in that position. Okay. So what we will do is we will say, okay, fine. Now it's February, now September, let's take a loan. Now the problem is this. In February, interest rate may be 10%. Okay. And we can forecast everything based on that 10% in September also. But what is the guarantee that interest rate in September also will be 10%? That is interest rate risk. Today, we are doing all our forecasting based on 10% interest rate, but there is a chance that the date of transaction, when we actually take the loan, what can happen? The interest rate might have changed at that point. So again, there will be a variability. Again, that's a risk. So like currency risk, this interest rate risk also we can hedge using different instruments. Okay. One thing you have to understand is currency risk in real life, it keeps changing. Now exchange rate, for example, it keeps changing every day. Now if you take the exchange rate last month to this month, you will see a big change. But when it comes to interest rate, it's not like that. Okay, so interest rates, they don't change as often as exchange rates, but they do change and we have to hedge for that change. Okay, right. So let's read this question. They talk about a few instruments that you can use to hedge your interest rate risk. Okay. So it says here, the directors of Plum Company expect their interest rates will fall over the next year, and they are looking forward to paying less interest on the company's debt finance. Okay. Now, if you remember at the very beginning, when I started speaking about this, I told you there are two types of loans, right? One is fixed and one is floating. Okay. And if you're not comfortable with paying floating, then you can simply go for a fixed rate loan. Okay, then some of you might have the question, okay, fine, then why in the world is there a floating rate? Why does that exist? everybody will want to go for fixed rate loan because there won't be variability. Yeah. The reason is if you have a floating rate loan, if your interest in the market, if it drops, if the interest rate in the market drops, then you will benefit from that because you will end up paying less interest if you are having a floating rate loan. Whereas if it was fixed, then even if the market interest rate drops, you will have to pay the higher rate because it was fixed. Okay, so that is why some people, if they're predicting interest rate in the market to actually drop, then they will prefer to go for a floating rate loan compared to a fixed rate loan. Okay, so that's the reason why we have those two options. If not, if nobody likes variability, if nobody wants to take the risk, then they would only have fixed rate loans. Okay, so the reason why we have a floating is because suppose somebody is forecasting interest to drop, there is a chance that they will opt for a floating rate loan. Right. Then it says the dollar is the domestic currency of Plum company. So home currency is the dollar. Okay. Sorry, just give me a second. Yep. Home currency is the dollar. The company has a number of different kinds of debt finance. So what are they trying to say? Now, if you are a company, you won't just have one loan, right? You will have so many loans. Okay, so they're saying that they have 4 types of debt finance. So what are the 4 types? The first one is a loan note. Okay, and the denomination is a dollar. So they have taken a dollar loan note. Okay, so they have issued loan notes and the currency in which they have issued that is the dollar, which is their base currency. The nominal value is 20 million. Interest rate is 7 per year. The interest type, it's a fixed rate. Interest is due in 6 months' time. And the redemption is going to be in 8 years' time at nominal value. So that's a lot of information about that particular loan note. Okay, so let's look at that later. For now, we'll just read through everything and see if, there's something we can take out of this. So right now, when you're reading the question, you can see just a little bit of information. Then there's another loan note that they have taken in pesos. Now, peso is not their currency. Now, first of all, we don't know why they took in pesos. We have to read on. But anyway, they have taken pesos. Nominal value is 300 million pesos. Interest is 10 per year. Fixed rate interest. Interest is due again in 6 months' time. And you can redeem it in 8 years' time at nominal value. Then there is a bank loan, again dollar. That's fine, base currency. 4 million, 8 per year. This is a variable rate, 6 months' time. Redemption will be in installments. So every 6 months, you might pay an interest and a little bit of the principal as well. Okay. Overdraft, they have taken overdraft facility as well. Dollars again, 3 million, 10 per year, variable rate. You have to pay interest monthly and it's continuing at current level. Okay, so redemption, like if you pay back the overdraft, then it will reduce. If not, it will just keep on being there. Right. Now it's saying the 7% loan note. So which one is the 7% loan note? This one. Okay, this one. The 7% loan notes were issued domestically while the 10% loan notes were issued in a foreign country. Makes sense, right? This 10%, it's in pesos. Okay. So they're just telling us that. They didn't tell us why they did that. The interest rate on the long-term bank loan is reset to bank base rate plus a fixed percentage at the end of each year. So if you look at this bank loan, it's variable rate. Okay. So what that means is every year the interest that you have to pay, it will keep on changing. So how do we calculate that? It's a bank base rate so that they will decide every year plus a fixed percentage. Okay. So every year, since the base rate is going to change, ultimately the amount of interest rate that you pay every year, it will change. So that's why it's called a variable rate. The annual payment on the bank loan consists of interest on the year-end balance plus a capital repayment. So every year you will pay interest and a little bit of a repayment of your principal as well. Then they're giving us exchange rate. Spot rate, pesos to dollars. 6 months forward rate, again pesos to dollars. So we have a spot rate and a forward rate. Plum company can place pesos on deposit at 3% per year and borrow dollars at 10% per year. The company has no cash available for hedging purposes. Right. Now, when you see this, right, the moment you see this relevant exchange rate, spot rate, and these forward rates and the deposit percentages and all, it should ring a bell. What is this bell it should ring? It should ring a bell saying that it's giving you information for a money market hedge. Okay. If they're giving you peso deposit and dollar borrowing rates, then that is definitely the kind of information that you need to do a money market hedge. Okay. So when you're reading the question, you must understand that. Now let's see what the requirement is. It's saying, evaluate the risk faced by Plum Company on its peso-denominated interest payment in 6 months' time and advise how this risk can be, and advise how this risk might be hedged. Okay. So, evaluate the risk faced by Plum on the peso-denominated interest payments in 6 months' time and how you can hedge that risk. So, what is the risk that they are facing? First, you have to mention that. The thing is, we have to pay 10% of 300 million pesos. Okay, so let me write down what we know so far. Okay. So what do we know so far? Today, if we were to pay 10% of 300 million, so that is going to be 3 million pesos. Right? So let me put it like this. So 300 million is there. I'll do it in thousands, sorry, in millions. Okay. Now, of this, the interest component is going to be 10% of this. Okay. So, we will have to pay 30 million pesos today. Okay. Now, the thing is, if we are going to convert this 30 million pesos into dollars, because our base currency is dollars, right? We are not going to have 30 million pesos in our hand to actually pay it straight away. So what we will have to do is, we have to buy pesos from the bank. We have to buy pesos from the bank. So that also means that the bank sells pesos to us. Okay, and always remember, the bank sells high. Bank buys, bank sells low. Sorry, bank buys high and sells low. Bank sells low. Sorry, guys, I got a little distracted. Okay. So we have to buy pesos from the bank because we don't have pesos to pay this 30 million. The bank will sell pesos. If we are going to buy, then the other party will have to sell, and always the bank will sell at the lower rate. So today, if I were to pay this 30 million, how much will it cost me in dollars? Look at that. We have two rates, spot rate 58.335, 58.345. So if they are going to sell low, the rate we have to convert is 58.335. So that will be 30 divided by 58.335. Okay. So that means you will have to pay $514,271 if you are going to make this payment today. Okay. But now the problem is, the payment is not going to happen today. The payment is going to happen in 6 months' time. Okay. So let's convert the same 30 million, but using the 6 months rate. Okay. And see how much we will have to incur in dollars. So 6 months, what will happen? Same 30, but this time we can't convert at 58.335. We have to convert at 56.585. So that will be $530,176. Now that is the problem that we are having. Okay. If we were to do this conversion today, it would only cost us 514,271, the payment. But if we are going to do this in 6 months' time, then we will incur a cost of 530,176. Okay. So the increase interest is going to be the difference, which is 15,905. So that is the risk. Okay. That is the risk. If we did the same thing today, it would only cost 514. But if we did it in 6 months' time, because of the interest rate changes, it will be 530,176, increase of 15,905. Okay. So you have to say that that is the evaluation. That will get you 1 mark. Okay. That is the evaluation. Now the next thing is they're saying, fine, this risk is there. We can't help it. How are we going to hedge this? How are we going to reduce this risk? Okay. One option that you can have to hedge this risk, one option is you can go for a forward. Okay. You can go for the full term, we call it the forward exchange contract. Forward exchange contract, basically you go to the bank today. Okay. So now in 6 months now we have to go for the payment. Today itself you go to the bank and say, in 6 months time, I have to say, what do we have to do? We have to buy pesos. I have to buy pesos. You have to sell me pesos. How many pesos am I going to buy? 30 million. Okay. So today itself you tell me at what rate are you going to give me this 30 million pesos in 6 months time. Bank will quote you this rate because that is only the 6 month forward. 56.585 and 56.597. Then you say, okay, fine, that's the rate. No, I don't want risk. Risk is variability. Okay. So what I will do is I will agree with the bank and say, fine, I don't want to take any risk. I will agree on this rate. In 6 months, when I come to buy the pesos, you should give it to me at this rate. You sign agreement, you come. Okay. And then what will happen in 6 months? The same thing, you can do it at 56.585. How much will it be? 530,176. Now you might have a question. This is expensive, right? 530,176. It's expensive because if we do it today, it would only be 514. Okay. But understand this. When it comes to financial management, we don't care about whether it's a profit or a loss. That is not risk for us. Risk is variability of return. But now when I enter into the forward exchange contract, it's going to be 530,176. Not a dollar more, not a dollar less. That's what I want. I don't want any variation from the forecast. So today itself, I can forecast this expense and do my budgets according to that. Okay. So that's the first option that I can go for. What's the next option? I can go for a money market hedge. Now, how do I know that money market hedge is an option in the paper, in this question? Like I said, it has given you all the information that you need for a money market hedge. Okay, so definitely they won't just give you such a lot of information to confuse you as such. Okay, maybe 1 or 2 pieces of information, yeah, it can happen. But if they give you so much of information relating to a money market hedge, chances are that they will ask you to do it as well. Now, what you have to understand here is, usually they will say use the money market hedge or use a forward exchange. But in this question, they are not telling you it directly. So you have to be careful. Okay, because at your exam, you might think, okay, no need money market hedge. No way are they asking for it. Okay, but based on the information, you have to be able to, understand that they need that calculation. Right. So let's see how a money market hedge will be done. Right. So this is the format that you will have for a money market hedge. So let's see what happens. 6 months. Okay. So in 6 months time, what's going to happen? We are going to make a payment of how much? 30 million peso. Okay. Now, always remember a payment is a liability in 6 months' time. Okay. So, if you're going to have a liability in 6 months' time, then today you have to do the opposite. You have to create an asset. That is only money market hedging. You have to create an asset. Okay. So, how do we create an asset? Think about it. Is a deposit an asset? Or, I mean, if you deposit in a fixed deposit, is that going to be an asset? Or will borrowing money be an asset? Okay. When you deposit cash, will it be an asset? Or when you borrow money, will it be an asset? Think about it. When you deposit only, it will be an asset. Okay. So, what will you do? You will deposit 30 million pesos. They have given me the rate. Okay. They can place pesos on deposit at 3% per year. So, you will deposit at 3%. Okay. 3% is a yearly rate. We only need for 6 months. So, it's going to be 3% into 6/12. Okay. We don't want to deposit for the yearly rate. We will do it only for 6 months. Okay. Then we have today. What's going to happen today? Now today, we are going to deposit this 3 million pesos. Okay. But what you have to understand is 3 million is a future value, meaning it's going to happen in 6 months' time. So today you don't have to deposit the entire 30 million. You can deposit the present value of that 30 million. Okay. So how do you get the present value? That will be 30 million divided by, okay, I'll put it underneath, divided by 1 plus the rate you're depositing at is going to be 3% into 6/12. So that's going to be half of 3, 1.5%. That's the present value. Okay. So what will the answer be? You will deposit 30 million divided by 1 plus 1.5%. You will deposit 29,556,650 peso. Okay, that is the amount. That's the amount that you will deposit. Let me just write it here. 29,556,650 pesos. Okay. Now, we are saying create an asset, deposit this amount. Okay. Now, first thing is this is a foreign currency. We are not going to have pesos in hand to just go and deposit it like that. Okay. So, first of all, we have to find out how much is this amount in dollars. Okay. So, we have to convert this into dollars. So, that will happen at the spot rate. Okay. That will happen at the spot rate. So, now we are trying to buy pesos. Okay. Because if we buy pesos only, we can deposit it in the bank. We are telling to deposit at 3%. So, we are trying to buy pesos. If we are going to buy, the bank is going to sell pesos. And the bank sells low. Okay, the bank sells low. So, what's the spot rate? 58.335. So, they are going to sell at the rate 58.335. So, let's convert. 29,556,650 divided by 58.335. Okay, so that will give you, let me copy this. Okay, this I will divide it by 58.335. So that should give me an answer for dollars, which is $506,671. $506,671. Okay. Right. Let me just make this bigger to make it easier. Let me put arrows. Like usually we do it with arrows. So let me just okay, so this will be one arrow, and then we convert it at the spot rate. Okay. So now we have to deposit $506,671. That is our plan. Okay. Now where are we going to get this 506,671? We have to borrow that. Okay. We have to borrow that because I'll go from the beginning. We had a payment of 30 million peso. We said this was a liability. So do the opposite and create an asset. And we said asset means you can't borrow, you have to deposit. And the rate also was given to us. We said deposit 29 million pesos. Okay. Now, first of all, we don't have money to deposit. Okay. And the next problem is this is a peso based figure. We don't have money in dollars. We don't have pesos also. So first let's convert it to dollars because anything can be done only if it is in dollars. Okay. So when we did that conversion, we figured out, okay, we have to deposit $506,671. Now we still don't have this money. So we have to borrow. Okay. We have to borrow dollars. If you look at the question, they gave you the borrowing rate, which is 10 per year. So borrow at 10% per year. So we only need for 6 months. So basically 5%. Okay. Then what happens in 6 months? Okay. What will happen? In 6 months, this dollar figure 506,671, it will grow by 5%. So it will become multiplied by 1.05, right? And finally, we will have $532,005. Okay, we will have $532,005. So this is the money market hedge. Okay, this is the money market hedge. Now this 532,005, you will have to compare it with the forward. So if you look at the forward, we are going to end up paying 530,176. Okay, according to the forward, we will be paying 530,176. But according to the money market, we will be paying 532,005. Okay, so if you compare the two, the forward will be the cheap option. So what will happen? This company, Plum company, they will have to hedge this risk by using a forward exchange and not the money market. Because if they use the money market, ultimately the amount that they are going to pay, which is 532,005, that is going to be higher than the forward exchange contract. Okay, so if you do all of this, you will get 5 marks. Now, you might feel that this 5 is a little less for this, right? It seems to be a lot of work, but it's only 5 marks. The reason is the question, right? Look at it. They have said they can place pesos on deposit 3 per year and borrow dollars at 10 per year. Now, usually in money market hedging, they will give you the deposit rate and borrowing rate of pesos. And the deposit rate and borrowing rate of dollars, they will make you choose which rate. In this question, they are giving you exactly what you need for the question. Okay. So this money market hedge, you shouldn't get confused because you know if it's going to be something to do with pesos, we only have one rate, the deposit rate. So you don't have to think too much. You know that this has to be deposited at 3%. Here, you know, if it is something to do with the dollars, we only have one rate, borrowing rate 10%. So you will have to borrow at that rate. So that's why the marks is a little less. Otherwise, for a money market hedge alone, they will give you at least 5 marks. The reason why it's a little less in this question is this, because the rates, they have filtered it and given it to you. Okay? Right. So I'll give you a minute to take this down. Let me copy this on the other side so it'll be easier for you. So that's A part, right? So it's up to you to figure out that you have to talk about both the forward and the money market hedge. Okay. What you have to understand is the money market hedge, this last thing I didn't mention it, this $532,005, in 6 months, you will have that no, in hand. When you convert it based on the spot rate on that day, it should, if the money market hedge is, successful, it should equal to that 30 million pesos that you have to pay. Okay, so that's how the money market hedge works. Okay, so I hope you've taken this down. I'll just read out the marking scheme to you. These are how the marks would be, spread out. Okay. If you can say that you will pay an increased interest of 15,905. Okay. If you do the same transaction in 6 months' time, the interest will increase by 15,905. You get 1 mark. Then for the forward, you get 1 mark. For the money market hedge, you get another mark. Okay. And then if you're using the correct deposit rates and the borrowing rates, you get another mark. And finally, I mentioned this in words. You have to make sure that you type it. You have to say that since the money market hedge is expensive in comparison to the forward exchange contract, Plum company will opt to hedge the risk using the forward exchange contract. Okay, so if you say this, you get another mark. So this is how you get your 5 marks. Always, when it comes to constructed response, the marking for calculations, it tends to be lower than the amount of marks you will get for theory-based questions. Okay, so I've said this time and time again. It's always theory-based questions that will earn you marks when it comes to, especially when it comes to section C. Okay. Then let's look at the next question, next part actually. So A part is done. It's saying identify and discuss the different kinds of interest rate risk faced by plan. Okay, so what are the different kinds of interest rate risks that PLAM is facing? 5 marks. This is an example of where you just have to make 5 random points somewhere and you should be able to get the mark. Okay, so let's look here. Now, the first thing that you have to understand is some of their loan notes, they are fixed. Okay, whereas some are variable. So, the first interest rate risk is they say that we are expecting the interest rate, where is that? They say that it's expecting to fall. Here, The directors are expecting that the interest rate will fall. Then what will happen? The first risk that they are going to face is the fixed rate loans. The fixed rate loans, they might end up paying higher interest rate because they are not able to, take the benefit of interest rates falling. The variable rate loans, yes, they will be able to benefit from the favorable interest rates. But when it comes to fixed rate, they won't be able to do that. Okay, so if you explain that, they will give you between 1 to 4 marks just for that. Okay. Then it says, yeah. So this 1 to 4 marks, I'll just tell you 4 points that you can say, right? First thing is we can't benefit from lower interest rates. The next thing is this redemption, it's happening at 8 years time, right? Both these fixed rate, you're going to be stuck with that fixed rate for 8 years. So that is another problem because this fixed rate, the fact that you're paying a higher interest, it's not going to just be for 1 or 2 years. It will be for a long period of time. Okay, so that is another disadvantage, a risk that they will have to face. Other thing is, if they are going to pay fixed rate and their competitors have variable rate loans, then what will happen? Basically, the competitor has a competitive advantage. They will be able to give the same product for a lower cost because their cost is lower because of the interest rate. Okay, so that can be another point. So if you make those 3 points, that will be 3 marks. Okay. Then in addition to that, they have also given a gap exposure and basis risk. So that is a general answer, right? It has nothing to do with this particular question. What is this gap exposure basis risk? It's like this. When you have assets, okay, assets that are going to pay you interest, and you have liabilities, meaning you have to pay interest. If you can match them, okay, then you can reduce your interest rate risk. But suppose it's not 100% match, then what will arise? That is only called, the correct name that we use is called a negative gap if the liabilities is more. Okay, if the assets are more, it's called a positive gap. So basically, gap exposure talks about trying to match your assets with your liabilities. If you have 100% match, then you will not have interest rate risk. But if you don't and your liabilities are more, then you will have what is called a negative gap. And if your assets are more, it's called a positive gap. So if you just mention that also, those are certain points that can earn you marks. So you can go through the marking scheme. So like I said, part of the answer, it's coming directly from the question, but part of the answer, it's coming from an external area that we usually talk about when we are learning the syllabus. Okay, so everybody can't make all the points in the marking scheme. As long as you have 5 valid points, that will be more than enough. Okay, right. Now let's come to this part, because actually this is the more important part, right? This is why I even chose this question. Let's see. The dollar denominated loan notes. So what is the loan notes that are dollar denominated? This one. Okay. The dollar denominated loan notes each have a nominal value of $1,000 and are convertible. So first thing is it's a change. Usually loan notes are $100 nominal value. But in this question they're saying it's $1,000. It's fine. We have to accept it and it's convertible. So what is convertible? It means you can either redeem it or wait till redemption, or you can convert it into shares. So what is redemption? It's like this. If I am the company, I have issued loan notes, means I am telling other people to give me some money. I need a loan. Okay. Redemption means after 8 years, I will repay the money to whoever bought the loan note and I will close the deal there itself. After that, I don't have any relationship with the investor. That is only a loan note. What is a convertible? It's like this. The person who gives me the money, he can choose, okay, is he going to take the money and, stop business with me? Or he can convert those loan notes to shares. Now, let's say he's very happy with the company. For example, he's very happy with the company. He wants to do business with you. He wants to become a shareholder. Then, if it's a convertible loan note, he has an option to convert the loan notes into shares. Okay? That's what it's saying here. As an alternative to redemption in 8 years, the loan note holders could, after 7 years, convert each loan note into 110 ordinary shares of plan. You have to be careful here. Okay. They're saying as an alternative to redemption. Redemption, if it happens, it will happen in 8 years' time. But instead of doing that in 7 years, 1 year before, they can convert the loan notes into 110 ordinary shares. The ordinary shares of Plum are currently trading at 6.5 per share on an ex-dividend basis. So ex-dividend means you don't have to worry too much. Anything you have to use ex-div, or if it's an interest, it has to be excluding interest. Okay. The current cost of debt of the convertible loan notes is 8%. Requirement: justify any assumptions that you make. Calculate the current market value of the loan notes in Plum using future share price increases of 4% per year. So they're saying, suppose this share price, 6.5 it is today, suppose it increases by 4% every year, they're asking you to calculate the market value. Then they're asking, what will the market value be if not 4%, it increased by 6%. Okay. So I'll give you 5 minutes. Try to analyze how you can do this. Okay. I'll just talk about the steps, right? It's a convertible. So first you have to decide, are we going to convert or are we going to redeem? How will you make that decision? Based on the market value of the share. Okay, first thing. After that, this is a loan note. It is redeemable loan notes. So if you need the market value, you have to do a calculation similar to an NPV. That will definitely give you the market value of the loan note. So the second part, most of you should be okay with it. The first part, deciding whether to convert or not, you might have a small problem. So I'll give you about 5 to 10 minutes. See if you can at least do for 4%, and then we can do it together. Right. So let's start. So first you have to decide whether you're going to convert or whether you're going to redeem. Okay. So if you're going to redeem, redemption is at par. Okay. So let me just show you that. The interest, let me check here. Yeah, 8 years time at nominal value. Okay. So at $1,000 only, they are going to redeem it. So when you convert it, only if the conversion value or the market value of these shares, 110 ordinary shares, only if it is more than $1,000 will you go for the conversion option. If not, you will definitely go for the redemption option. So let's see how much is this 110 ordinary shares worth in how many years time? In 7 years time. Okay. Right. So today they're telling me shift it here. So today we know that one share is $6.5. $6.5. And this is going to get inflated by how much? Inflation is 4%. So 0.14, it will get inflated. And let's check how much that will be in 7 years time, right? Because in 7 years only you can do the conversion. So in 7 years, this will be 6.5 into 1.04 to the power 7. So that will be 8.55 per share. Okay, so this 6.5, it will get inflated every year by 4% and it will become 8.55 in 7 years time. Let me check. Market value 540. 1 second. That's part of the answer, Shan. That it's not the market value. Okay, it's part of the answer though. Okay. Right. So one share in 7 years time is going to be worth $8.55. How many shares are they giving you for one loan note? They're going to give you 110 ordinary shares. So 110 shares at 8.55 per share. Right. So that will be I'll just do it. 110 shares into 8.55. That means the conversion value will be $940. Okay. So what that means is if I convert, then one loan note will be equal in value to $940 because one loan note you will get 110 shares. 110 shares, if you multiply it by 8.55, then you will get 940. Okay. Now the question is this. If we go for the redemption, okay, we can redeem at $1,000. Now, if we go for conversion, it will give us 940. But if we go for redemption, then it will give us $1,000. Now, you might say, okay, we'll go for redemption. Okay, but be careful, right? Because conversion happens in 7 years. Redemption happens, if you look at the question, it happens in 8 years. So you can't just compare this 1,000 with 940 and take a decision. Okay, because one is a 7-year figure, one is a 8-year figure. So we can't obviously convert 7 years to 8 years. We can't make a present value or future value without any data. But we can take a future value and make it a present value. So let's take this 8 years, the cash flows that happens in 8 years, and let's use a discount factor and make it 7 years. Okay, let's calculate the present value, not the present value, in fact, the value at 7 years. So then only we can compare it with 940. Now, in 8 years' time, that's the last year. Not only the redemption will be, the redemption won't be the only cash flow, right? There will be an interest also that happens on that year. So how much is interest? Let me check. 7%, right? So 7% into, let me just check that once more. Yeah. So it will be 7% into 20 million. So let me check how much that will be. I'm just checking if this is the correct loan notes. Dollar denominated loan notes. Yeah, that's the one they're talking about. Right. So 7% into 20 million. One second, because the values are different. Just give me a minute. I have a feeling there is a small problem here. Let me show you the answer. Just see if you can see what it is. Because I feel that there is a problem. Okay. This is 539. Yeah. So till this point, I think we have come. Okay. 940. They're saying this conversion value is less than the nominal value of 1000 per loan note and less than the expected market value of 990.82 per loan note at the end of 7 years. But I feel there is a problem here because they are saying that the redemption value plus the interest received in the 8th year is going to be 1070. Okay, but if it has to be 1070, that means the interest has to be 70, right? But in our question, there is no way that 7% of 20 million is going to be 70, no? So there can be a problem there. Yes, I feel that there is a problem there, okay? So let's just not consider that because if you need interest, Lam was what number? So you will come across this, okay? In your questions, you will come across this where you might have a slight mismatch. But wait, I'll just check once more, okay, without concluding. 178. Okay, I think I spotted it. Okay, let me check. Okay. Can you figure out where I went wrong? I mean, not go wrong, what I missed. Because I also didn't see this question before, but now suddenly I realize what happened there. So to calculate this interest, I'll show you what went wrong. Sorry. Okay, so to calculate this interest, it's 7% of 20 million, right? But that was an annual figure. Okay, so if you're calculating this for 6 months time, you would do 7 into 6 over 12. So that's what I also missed. You might have missed it. If you haven't, then great. So that will be 3.5% of 20 million. Okay, so 3.5% of 20 million will be 70. Right, so the interest, it will be 70. So the total cash flow that will happen in the 8th year will be 1070. Okay. Now, if we convert in 7 years time, it will be 940. But if we are going to redeem, we only have figures for 8 years. So we need to convert this back to 7 years. So this you have to multiply it with the discount factor. And what was the cost of debt they're telling us? 8%. So you will have to do it at the discount factor for 8% at 8 years. That will be, let me check that. Okay, if you can get that figure for me, it will be easy. I think it's 0.926 if I'm not mistaken. Okay. Yeah, 0.926. Right. So the present value, that will be 990.82. Okay. So what we need to compare is this 940 and this 990.82. Okay. So now, although we went through all of this, even if we had missed this, we had compared it with 1000 even, still we would have gone for this option. Okay. But then we have to compare it. That's going to be 990.82. That is going to be for 7 years. Right. So let's go ahead and do the market value. So conversion is going to be 940. This will be 990. So we will go for the highest option. We will redeem. After this, it's straightforward. So these are the years. We have year 1 to 8. And then we have the redeeming that will happen, the redemption. It will happen in year 8. Right. So the cash flows, interest will be, how much will it be? The interest was 70. And the redemption, it will happen at 1000. Now here it's going to be 1000, right? Because we're talking about year 8. You didn't understand the interest part, Shan. Yes. So see, it's saying the interest is 7% per year, but we are not going to pay interest in 1 year's time. You're going to pay it in 6 months' time. Okay, so that is why you're taking 7% into 6 over 12 into the 20 million. So that will give you 70 million. Okay. Right. So years 1 to 8, you will get 70. The discount factor at 8%. But I agree, it's not very clear because although it's the 6 months time story is there over here, they should tell us that it was 2 interest payments that they have not mentioned. But if I have to go with the marking scheme, then we have to make that assumption. Okay. Right. So discount factor at 8%. Here it's going to be an annuity. So that is 5.747. And the redemption you have to get the discount factor, which is 0.540. Then you get the present values, which is the cash flow into this. And here it will be the same. Okay. So 402.29 and 540. So you can take an addition of these two and you will get the market value as 942.29. Okay. So that is the market value of this particular bond if the market price is increasing by 4% per year. Okay. So first you have to figure out what is the conversion options price. If it is less than the redemption, then we will go for the higher one. We will obviously want more. Okay. But although we are, I know we calculated this figure. Okay. We did calculate it, but we are not using it anywhere. Okay. When we are doing the present value, you have to use the redemption of 1000 only because the redemption will happen in 8 years time. Okay. Right. So that's about the 4%. Why won't it be 7% of nominal value? We usually do that. Let me check. Okay, wait. Right. They have said nominal value is 20 million. Actually, they have made a mistake, guys. That's why even I got confused. The nominal value, they're saying here it's 1000. Okay. But here when I saw it, I just felt like that was a nominal value, but that is the total number of loan notes that they have. Okay. So that will be the actual nominal value is 1000, correct? But that multiplied by the number of loan notes will only give you this 20 million. So yes, when I saw this also, I thought, okay, why is this there? But you're right, Shan. So if you take 7% of 1000, that will give you the correct value, which is 70. That's why I showed you guys the answers as well, because I felt I was missing something. Thing is, them giving this like this is not very clear. So what you're saying is correct, 7%. So let's stick to that because that makes more sense than what I have said here. So 7% into the 1000 will make more sense, correct? No problem. Because in this question, why, first of all, I chose this for two reasons, right? One is, usually in conversion, we don't have this 7-year, 8-year problem. Okay, first thing is it will happen in the same year. So we have to make sure that we don't make that mistake. The other thing is, usually nominal value is not 1000, it's 100. Okay, so that's why in this question, when suddenly changed, even my brain is not processing it properly. Okay, so what you're saying is correct. That will be 70 that way. Because I kind of processed that here the nominal value is different, right? So that's why when I saw 20 million also, quickly I thought this will be the nominal value, but actually it's 1000. Okay, so that's fine. Thank you, Shan, for that. Right. So let's do the same thing. 6 per year. Okay, so if it was happening at 6 per year, then what will happen? 6.5, it will increase by 1.06. Okay, so it will become 9.77. So the 110 shares will multiply it by 9.77 and the conversion option will give you 1075. Okay, it will give you 1075. You have to compare this with the redemption option. Redemption was 990.82. So in this case, we will go for conversion. So let's have the years. We have year 1 to 8. We have the interest, which was 70. And then in this case, we will go for conversion. Which is on the 8th year. The amount that we will convert is, how much was it? 1075. Then let's get the discount factor at 8%. 1 to 8 years, that will be 5.206. And here it will be 0.583. Let's get the present values. It's going to be this into this. Okay, so the total market value will be 991.15. Okay. So here there won't be a problem because we know exactly what to do with the conversion. So this will be at market value of shares. So it will be at the market value of the shares. Right. So that is the 6 marks. Then look at the D part. It says, discuss the limitations of the dividend growth model as a way of valuing the ordinary shares of a company. Okay, so the limitations of the dividend growth model. So you can, first, you have 4 marks. 1 mark, you can explain what the dividend growth model is. Okay, so what is the dividend growth model? We value the ordinary shares of a company. How do we do it? We do it based on one assumption. What is the assumption? We are saying that the present value, okay, the market value of a share is the present value of its expected future dividends. Okay, so that's what we say, no, it's an assumption that we make. The amount that you will pay as market value, it will be equal to how much dividends that particular shareholder will get in the future. But again, we don't just take the dividends, we take the dividends, which is a future value, and we discount it to present value. Okay, so that is the first thing that you can say. Then we can say limitations. They're asking for disadvantages. First thing, it's very difficult for us to properly get the dividend figures. Okay, because past dividends we can get, but future dividends, for us to predict it with certainty, that is going to be difficult. Okay, then we use something called a growth rate. When it comes to dividend growth model, we say it's 4% or 5% or 6%. But in real life, dividends won't grow at a fixed percentage like that. 1 year it might increase by 2, another year it might increase by 8, another year it might increase by 5. So in that situation, we can't use the dividend growth model. Other problem, if you remember in the dividend growth model, we have the cost of equity that we use. We say the equation goes like this, right? We say P naught equals D naught 1 plus G over okay, I'll just write it here. KE minus G. Okay, we say it's KE minus G. So here I told you one problem is this growth won't always be constant. The other problem is this KE, that will always not be constant because that is the required return for equity holders. No? So sometimes now if they perceive the company as risky, their required return, it might actually increase. So KE also doesn't necessarily have to be constant. So those are the limitations of the dividend growth model. Okay. So this is a very, I don't know, this particular question, whoever did it in March 16, when they see it, it has a lot of reasons for you to get disoriented in an exam. First problem is the nominal value is changing. Okay. The next problem is the redemption and the conversion is not happening at the same date. Okay. And then another problem, actually, A itself is a problem. Why? Because they are not telling you to do a forward or a money market hedge. You have to decide that. Okay. So don't, now in your exam, if you have a question like this, guys, don't worry. Okay. Because let me tell you why not to worry. Getting this 940, everybody would have got it. Okay. But this part, this redemption and the interest part, lot of people might not have got it. They would have compared this 940 with the redemption value of 1000 itself. But even if you did that, this part cannot go wrong. Okay. Because whether you do 990 or 1000, either way 940 is a lower option. So you will anyway choose the redemption. And even in the second part, it's 1075 versus this 940. Anyway, you will choose the 1075. So in your exam, even if you hadn't figured this part out, it wouldn't be a problem. All your answers will be correct. Okay, so when you're, why I chose this is, when you're doing questions like this, you might find yourself stuck. Now see, even I missed the main point here. Okay, like to the point where I was thinking, okay, is the thing actually correct? Reason is because in our brains, we think of it as 100. So I was thinking it should be 7. I was first wondering, why is it 70? And then I looked up and I saw nominal value 20. I thought, okay, the nominal value is different. But even then when you multiply, you're not getting it. Then finally, okay, only when you think of the 6 months, you're getting it. So I thought, okay, maybe it's a 2 monthly interest payment. I mean, 2 years, twice a year. Okay. So likewise, there will be questions like this that you will have to face. What I'm trying to say is don't worry too much about it, because even if you miss some point that is very tricky, the examiner knows that that's a tricky point. You will only lose 1 mark. The remainder of it you will definitely get. Now look at D part, for example, easy marks. Okay, right. So that's it for this question. Hope it's clear. Now it's 7:23. Take 15 minutes, pray, do whatever you want, and you can come back in 15 minutes. We will do another question based on cost of capital. That is also a little different. And another one based on investment appraisal. Okay, I don't know if we will have time. I hope we'll have time. Okay, so be back at 7:40. Okay, and please try to come on time. Okay. Right. I hope you guys are back. Let's do another question. Now that's going to be AMH company based on cost of capital. So that is this one, page 155. Oops. Yeah, this one. Okay, so let's read the requirements first. It says calculate the market value weighted average cost of capital of AMH. Okay, so they're asking for the WACC. Now, usually we read a question like this on Sunday as well. We find WACC using the equation. Okay, usually we find WACC using the equation. But here, if you see, we have ordinary shares, we have preference shares, we have bonds, and we have long-term bank loan. Now, weighted average cost of capital means we have to take all of them into consideration, right? Because everything is a source of finance. So, if we want to know the total cost of our capital, we have to take a percentage from ordinary shares, percentage of preference shares, percentage of bonds, percentage of a long-term bank loan. Only if we do that, we can get the weighted average cost of capital. Now, again, like the other question that we did, the problem here is we can't directly use the WACC equation. Okay, because if we were to use the WACC equation, let me show you that also. In case, but I think those who are here already know this. If you look at the WACC equation, yeah, we need, we can use this equation only if we have one equity and one debt. Okay, so maybe ordinary shares and bonds, preference shares and bonds. Whatever it is, it has to just be one source of equity and one source of debt. Only if we have two pieces of information like that, you can use this WACC formula. But in this case, you can see there are 4 different types of capital. So we can't use this formula. So what do we have to do to get the WACC in this situation? And you will see that in your exam, most of the time, you will encounter situations like this. And you can see they're giving 12 marks just for this. Okay. So let's read this and understand what the question is saying. Okay. AMH company wishes to calculate its current cost of capital for use as a discount rate in investment appraisal. We all know that. We calculate cost of capital and then we can use it in things like NPV calculations to discount the cash flows. The following financial information relates to AMH company. Financial position statement extracts as at 31st December 2018. You have ordinary shares, you have reserves, you have long-term liabilities, preference shares, bonds, long-term bank loan. The ordinary shares have an ex-div market value of 4.7 per share and an ordinary dividend of 36.3 cents per share has just been paid. Historic dividend payments have been as follows. They're giving you payments of past dividends, 2004, 5, 6, 7. This is 2008. So 4 years of dividend payments, they're giving you what it was. The preference shares are not redeemable and have an ex-div market value of 0.4 per share. Okay. The 7% bonds are redeemable at 5% premium to their nominal value per bond and have an ex-interest market value of 104.5 per bond. The bank loan has a variable interest rate that has averaged 4% per year in recent years. They pay tax at 30% per year. Now they're asking you for weighted average cost of capital. So this is AMH company. A part, they're asking for the WACC. Now, we can't use the equation. Okay. And they're telling you to calculate market value weighted average cost of capital. So first, let's get the market values of all of the different types of capital that we have. So we have ordinary shares, we have preference shares, then we have bonds, and then we have a bank loan. Okay, we have all of this. Let's first get all their market values because this is market value WACC. So if you look at the ordinary shares, we know that, where does it say that? The ordinary shares have an ex-div market value of 4.7 per share. So one share is going to be $4.7. If we multiply this by the number of shares that we have, then we will be able to get the market value of these ordinary shares. So the number of shares that we have, look here, we have 4 million. Okay, it's in millions. We have 4 million worth of shares and each share has a nominal value of 50 cents. So if we were to get the number of shares, then you have to divide that 4,000 or 4 million. We are doing it in millions, so I'll just call it, we are doing it in thousands, so I'll call it 4,000. 4,000, you have to divide it by 0.5. That will give you the number of shares in issue. So let's do that. 4,000 divided by 0.5. Don't do 50 cents because the market value or the market price per share is in dollars. Okay, so this also has to be in dollars. That's why I said 0.5. So the market value will be 37,600. Okay, that's the market value. Right. Next, let's do the preference shares. What do they say? The preference shares are not redeemable, so it's irredeemable. And they have an ex-div market value of 0.04 per share. So 0.04, oh sorry, 0.4 per share. You have to multiply it by the number of shares in issue. So we have 3,000, nominal value is $1. So 3,000 divided by 1, which will be 0.4 into 3,000, which is 1,200. Bonds. The 7% bonds are redeemable at a 5% premium to their nominal value of 100 per bond and have an ex-interest market value of 104.5 per bond. So the market value is 104.5 multiplied by the number of bonds in issue. So that is 3,000. Okay. Nominal value is $100 as usual. So 104.5 into 3,000 divided by 1,000 will give you 3,135. Okay. Make this smaller. Right. Bank loan. Bank loan doesn't have a market value as such. How much ever the loan was for, that is only the market value. So that will be 1,000. Okay. Now what we can do is we can take a total of all of this. That is 37,600, 1,200, 3,135 and 1,000. Okay. So that is 42,935. That is the total. Okay, now watch this. This is how you would do WACC in a situation where you can't use the equation, right? Now, we need to take a portion of each of these, right? So, we need to calculate something called weights. Okay. So, how do we calculate this weight? It's very simple. What we do is we take 37,600 and we divide it by the total, which is 42,935. Okay. So, watch what I'm doing and then it will make sense to you. Okay. So this will be 37,600. I divide it by the total, which is 42,935. Same thing I do here as well. Everything I'm going to get weights. Okay. Now, let me just take this to 3 decimal places. Take everything to 3. Okay. Now let me show you the VAC equation. Okay. If you take the VAC equation, we take the value or the market value of equity, the market value of debt, and we divide it, can you see, by the total of equity plus debt. Now this total of equity plus debt is only this 42,935. Okay. So what we have done is we have taken the value of equity. This was ordinary shares, preference shares, the bonds and the bank loan, everything. And we have divided it by the total of all the instruments that we have in issue. So if you see, what have we actually done? We have done this part, the bracket. Okay, whatever is inside the bracket, we have done. Now that figure, you have to multiply it with the cost of equity or the cost of debt. Okay, so let's do that. Ordinary shares, of course, you will multiply with the cost of equity. Bonds, you will multiply by the cost of debt. So let's put cost of capital, or let me just say cost of equity or debt. Okay. So let's go back to the question. It should be given to us. The ordinary shares, let me check. Okay, so of course, yeah, they have not given it, right? They're giving us the ordinary shares, ex-div market value is there, ordinary shares, the dividends are given. All the information that you need to calculate cost of equity is given. All the information that you need to calculate cost of debt is given, but they haven't given it to us directly. So we have to calculate the cost of equity or debt. Okay, so let's start with the cost of equity. Of course, right? It's 12 marks, so they wouldn't have given it. Right, so if you're talking about equity, let's start with the ordinary shares. Okay. So we know that we can use the dividend growth model here. We can't use CAPM. We don't have anything to do with betas or anything. So definitely the approach that we have to use is the dividend valuation model. So for the dividend valuation model, DVM, let me get the equation quickly. These are the equations that we have to use. It's not getting copied. Okay. Right. So for us to get the cost of equity, okay, so that's basically this RE, we have to get that figure. We have to have the market value, which we already have. They gave us, it was how much? For ordinary shares, it was 4.7. That was given. We need to know the dividend. That's the current dividend. That also we have. But we don't have the G or the growth. Okay. So we need to calculate growth. And how can we do that? By extrapolating past dividends. Okay. That's the only way we can calculate the growth. So what is the equation for that? Ah, yes, that one they don't give. Yeah, that equation they don't give. You have to know it. It's like this. It is the D naught. Okay, so it's D naught. I'll just write it as D over the dividend n years ago. Okay, it's the D naught over the dividend n years ago. This whole thing you will take to the power 1 over n minus 1. Okay, so this is the equation that you need to use to calculate the growth. D naught, it's given to us in the question as 36.3, current dividend. Okay, they're saying they have ex-div market value of 4.7 and an ordinary dividend of 36.3 per share has just been paid. So you need to take that 36.3. So 36.3, you divide it by the dividend n years ago. So the oldest dividend that you have is 30.9. That's the oldest dividend that we have. Over 1 over n. So number of years. We are now currently in 2008 or 18. Okay. So 2014, in 2018, 2014 is 4 years ago. So this n will be 4 minus 1. Okay. So the growth rate will be 4.12%. Okay. That is the growth rate. So now we have the growth. We have D naught, which is 36.3. We have 1 plus G. We have P naught. Everything is there for us to get the cost of equity. Okay, so let's quickly get the cost of equity. P naught we know is 4.7. Okay, that should equal to, let me choose. Okay, 4.7, that is P naught. It should equal to D naught. So D naught is 36.3 cents. Okay. So that will, let's do it in dollars because 4.7 is in dollars. No? So in cents, that in dollars, it will be 0.363. 36.3 is cents. If you convert it to dollars, it will become $0.363 times 1 plus the growth rate, which is 4.12%, divided by the cost of equity minus 4.12%, the growth rate. Okay. Don't waste time rearranging anything. Just put it as it is in your cal. So that's 4.7 should equal to 0.363 times 1 plus 4.12%, close brackets, over KE is what we want. So let's put it as X minus 4.12%. Shift calc, it will solve for X. So that will be 0.1216. So that is in percentage, it will be 12.16. Okay. So KE equals 12.16%. Okay. So we have the cost of equity, that is of course for ordinary shares. Now you need to do the same thing for preference shares. Preference shares is not so complicated. It's simply the market value. Okay. The market value should equal to the dividend that you're paying, the dividend, over the cost of the preference share. Okay, so I'll just call it KP. This is the equation that you need to use. So it's the dividend over the cost of the preference share. Right, so we have the market value of the preference share, which is 0.4. This should equal to, what is the dividend that you're paying? Preference shares, 4% preference share, right? So that means we are going to pay a dividend of 4% into 1, which is 4. So in terms of dollars, that will be 0.04. Okay. So that will be 0.04 over KP. That's what we're finding. Okay. KP. Again, don't waste time rearranging anything. Just take your cal. 0.4 should equal to 0.04 over Kp, which is what we are finding. So X. Shift, calc, solve it. That is going to be 0.1. So in terms of a percentage, Kp is actually 10%. Okay, so we have Kp as 10%. Now we need to calculate the cost of debt. Okay, so cost of debt, we had redeemable bonds. Okay, so always remember, redeemable bonds means you have to do an IRR type calculation. Okay, so let's have the years first. So we have years. How many years is this for? 6 years. So 1 to 6 you have to pay interest, and in this 1 to 6 you have to pay interest, and in the 6th year you will redeem. Okay, so 1 to 6 you will have interest. The 6th year you will redeem. How much is the interest going to be? 7%. So that will be 1 second. Yes. We are calculating the cost of debt, right? So it's going to be like, it's not just the normal market value. We have to calculate an IRR because it's the cost of debt now. So let me bring the market value here. Here not, you will have the market value. Right. So what was the market value of these bonds? 104.5. Okay. And the interest, it was 7. But remember, if you are going to do this, now this is for a company, no? So if you are going to consider interest, here they have given you tax as well. So you can't ignore the tax. So it will be 7 times 1 minus t. Interest times 1 minus t. You have to have that as well. So t is 30%. So 7%, I'll get that figure. 7 times 1 minus t is 30%. So that will give you an interest of 4.9. Okay. So to show you exactly what I did here, it's interest times 1 minus t. So interest is 7. Okay. So interest is 7. 1 minus t means 30%. That's how I got 4.9. Okay, let's just put it like that. It's fine. Right. Then the redemption, it will happen at how much? It is redeemable at a 5% premium to the nominal value. So not 100, 100 plus 5%. So you will redeem at 105. So we have the cash flows. Now you need to discount it. Let's just, choose 2 random figures. Since the interest is at 7, let's just choose 7 first. Here not, it will always be 1. 6, if it's 1 to 6, it's an annuity. So you have to use the annuity factor. So 7% for 6 years annuity factor is going to be 4.767. Then use the present value table and get the discount factor at 7% for 6 years, which will be 0.666. And you can get the present values. So that will be, here it will be 104.5. Here it will be 4.9 multiplied by this. And here it will be 105 multiplied by this. Okay, so I'll just make this 2 decimal places. 23.36. Now you can take a total because we need an NPV now. So this plus this plus this. Okay. So that will be 100 and one thing we forgot. This is a negative figure, right? The market value is firstly a negative figure. So this will be minus 104.5. Okay, so this will be minus 11.21. That's the NPV. Usually if you write this, you won't make that mistake because we will put it in brackets, right? Right. Now, this NPV is negative, so we need the second NPV to be positive. So, if we want the NPV to increase, then the discount factor, you should choose a lower figure. So, let's go for maybe 7, no, so let's go for 2. This will always be 1. Annuity factor at 2% for 6 years is 5.601. Discount factor 2%, 6 years is 0.888. Present values. This will always be a minus 104.5. This is going to be the cash flow multiplied by the discount factor. Okay, same here. This figure, the cash flow multiplied by the discount factor. Okay, and then we can take a total. Okay. So that is 16.1849. Let's just take it to 2 decimals. 16.18. Okay. So we have 2 NPVs, we have 2 discount factors. So now we can calculate the IRR. So how do we calculate IRR? You should be familiar with the equation. IRR equals A, which is the lower discount rate, plus the NPV at A over NPV at A minus NPV at B times B minus A. Okay. So the lower interest rate, the lower rate was 2%. So that's 2 plus NPV at 2 was 16.18 over again 16.18 minus 11.21 times 7 minus 2. Okay, so let me get the IRR. When you put that in your cal, you should get 4.95%. Okay, so this is the IRR and it is also the cost of debt. Okay. Then finally, so we have done the cost of debt for the bonds as well. Last, we have to get the cost of debt for the bank loan. So for the bank loan, the cost of debt is basically the interest rate. So how much was the bank loan interest rate? 4%. Okay, it was 4%. But remember, this is excluding without taking into account tax. So you have to multiply this by 1 minus 30%, 1 minus T. So that will be 2.8%. Okay. So now we have all the figures that we need. We have KE, which is 12.16, KP, which is 10%. Then we have KD, which is 4.95, and the bank loans cost of debt, which is 2.8. So now using these weights, you have to multiply them with the respective cost of equity or debt. So let's put them one by one. Cost of equity was 12.16. Cost for the preference shares was 10%. Then the IRR was 4.95 and the other one was 2.8. And 2.8. Okay. So now, if you see what we are doing is, if you look at the equation, can you see we are multiplying everything by KE, KD, 1 minus T? That's exactly what we are doing now. Okay. So finally, let's call this the average cost of capital. So that will be basically the weight multiplied by the cost of equity. So that will be here 10.65. Let me just bring it all down. Okay. Take it to 2 decimal places. Okay. So 10.65, 0.28, 0.36 and 0.07. And when you take the total of all of this, okay, so 10.65 plus this, sorry. I'm just trying to show you what I'm adding. 10.65 plus 0.28 plus 0.36 plus 0.07. That should give you the average cost of capital, which is 11.36%. And this is, you can call it the weighted average cost of capital, the WACC. Okay. So you can see if you do all of this, you will get your 12 marks. So this question, basically you have done everything. Okay. What you have to understand is, although in the syllabus we keep talking about the WACC equation, more often than not, when you're calculating WACC, it has to be done this way. Get the market values, then divide the market value of the individual instrument by the total, get the weights, then get the cost of equity or debt, multiply the weight with the cost of equity or debt and get the average cost of capital, then add them to get the weighted average cost of capital. Okay, so this is usually how in a question you will see that. Okay. Right. So I'll give you a second if you want to take it down. So this is the format. It's good to stick to this format so you won't miss anything. So once you're done with the table, you should be able to calculate the cost of equity or debt for each of the instruments. The market value, yes. So if you look here, Shan, if you take the ordinary shares, we know that one share, the market value is 4.7. In the question itself, they give you that. See, the ordinary shares of AMH have an ex-div market value of 4.7 per share, one share's price. So today, if you go to the market and you have to buy that share, you have to pay 4.7 per share. So if we want to know the market value of all the shares in issue, then we have to find out what is the number of shares we have in issue. So if you look at this balance sheet, it says ordinary shares that have a nominal value of 50 cents each, its total value is 4,000. So if you want to know the number of shares that you have issued, take the 4,000 and divide it by 0.5, the 50 cents. Because if one share's nominal value is 50 cents, and if I divide the total number of, the total value, if I divide it by 50, then I will get the number of shares in issue. So that's what I've done here. 8,000 is the number of shares that we have issued. If we want to know the market value of those 8,000 shares, you have to multiply it with the current. Can you hear me now? Was it always like this? Or did it suddenly get off? Did you hear the rest of it that I was talking about? Okay, suddenly. Okay, because there was a button that got pressed. Okay. So I'll just repeat the market value that I was talking about. So see here, the market value per share, it's 4.7. Okay, per share, it's 4.7. So if I want to know the market value of all the shares in issue, I should multiply this by the number of shares that I have issued. Okay. So to get the number of shares that I have issued, I have the total value of the share. It's $4,000. I have to divide that by the nominal value 50 cents. That will give me the number of shares that I issue. So 4,000 divided by 50, I have issued 8,000 shares. And if I multiply that 8,000 with 4.7, which was the market value per share, I will get the total market value of my 8,000 shares in issue. Same for the preference shares as well. Okay. Same for the preference shares. The market value of the preference share multiplied by the number of shares in issue. No problem, Shan. Okay. Right. So I'll just finish off. For bonds also, it's the market value of the bond into the number of bonds in issue. So in this case, it will be 3,000. Nominal value for bonds, usually I told you it's 100, right? So divided by 100, which will be 3135. Bank loan, of course, market value will be the value of the loan itself. Okay. Right. So this is how we calculated the cost of equity. Okay. This is very important. You should know how to calculate cost of equity. Two methods are there. DVM, dividend valuation model, and another one called CAPM. If you are using CAPM, then you will get information like risk-free rates. Okay, you will get betas. Only then you will be able to use the CAPM formula. Okay, but in this case, we are not given any data relating to CAPM, and everything that we have is to do with the dividend. So definitely we have to use the dividend valuation model. Growth also, there are two models. One is extrapolating past dividends. The other one is Gordon's growth. So Gordon's growth, you have to have ARR and the payout rate or the retention rate. Both are not given. What we have is the information for this, the extrapolating past dividend method. So using that, we got growth, and then we put it in the equation, got KE. Preference shares was simple because it was irredeemable. It's just the dividend divided by the cost of the preference share. How did we get the dividend for preference share? Because they're saying it's a 4% preference share. Okay. Yes, Shan, tell me. What is the question? Okay, so that's what we did for the preference share. Cost of debt, this was redeemable. So if you want to get the cost of debt of redeemable loan notes, then you have to calculate the IRR. So that's exactly what we did. Bank loan, it was 4% interest. So that will be the cost of debt, the cost of this bank loan. But you have to take KD 1 minus T. In the WACC equation also, when we multiply by KD 1 minus T. Okay, so that's why 4% into 1 minus the tax rate, which is 30%. Market risk minus the risk-free rate is known as the risk premium. Correct, Shan. Called the risk premium. So sometimes if they just give you risk premium directly and not the market, the risk in the market, then you can just use the premium itself and multiply it with the beta. Okay. Right. The others also, if you all have random questions, you can ask. Okay. Right. B is saying, discuss how the capital asset pricing model. Okay. So I told you, if you want to get the market value of ordinary shares, you can either use dividend valuation or the other method was CAPM. And I told you we don't have information for CAPM. But here they're asking you to discuss something about it. They're saying, discuss how the CAPM can be used to calculate a project-specific cost of equity for AMH company, referring in your discussion to the key concepts of systematic risk, business risk, and financial risk. It's an easy question. When you see the 8 marks, should make you very happy because we have discussed this in detail, right? So I will give you 5 minutes. Jot down points, that 8 points. You should have 8 points. See if you can take down 8 points, and then I will give you the 8 points. See if it's matching with what you wrote down. Okay. Also make it a point. I mentioned this last Sunday as well. Make it a point. If you are writing new new points, I mean 8 points I told you. So make sure you have it in separate lines. Don't try to put everything in one paragraph. There is a chance that the examiner will miss. Okay. So they're telling you the words also. They're telling you use the word systematic risk, business risk and financial risk also. See, it's easier to get this 8 marks than get this 12 marks. If you understand what I'm saying. Because the 12 marks, there are, it's a lot of thinking that has to go into this calculation. It just doesn't just come. You have to know everything to do this back. But this 8 marks, it's a lot simpler. Okay. See if you can think of 8 points that you can write for this. Do we have 8 points? Okay. Right. So look here, they're saying to use the word systematic risk. So when it comes to CAPM, the first point that you have to say is that the model is based on one assumption. What is the assumption? We assume that all our investors are diversified. Okay, meaning they hold investments in different business, different industries. So they are not just investing only in our business. They have a big portfolio of investments. So first point is, in the CAPM model, we assume that all investors are diversified. And diversification, it reduces unsystematic risk. Okay. So according to CAPM, okay, the cost of equity that we calculate, it will only be the cost to compensate for systematic risk. So what is systematic risk? That is the type of risk that cannot be reduced even by using diversification. Okay, so that is the first point. Then comes the next point, where we have to talk about business risk and financial risk. Okay, so when you're talking about CAPM, CAPM is useful when the business risk. Okay, now for example, business risk means it is the kind of risk that you will have to face by being in that particular industry. So for example, I always use the example of, if you are in the umbrella industry, then you have a risk that if it's sunny, people won't buy it. Okay, so CAPM is useful when the business risk of the new investment, okay, the new investment that we are going to do, when the business risk is different from our existing business risk. Okay. Why is that the case? Because if the business risk is different, then what we can do is we can get the beta or the equity beta of a proxy company. So who is this proxy company? They are people who are already in the business of, whatever new investment that we are going to do, they are already in that business. So you can see here, AMH, they don't mention that, right? Yeah, they don't mention that it's a new investment, but just saying, if you have to talk about this business risk, you have to mention that. So what happens is CAPM is useful if your business is different to the business that you're trying to invest in. So what you can do is you can take the beta of a proxy company who is already in that business and you can de-gear that beta. So what is de-gearing? Removing the financial risk from that beta. So what I mean by that is your company has a different debt equity structure. The proxy company has a different debt equity structure. Now the debt and equity, that is what determines the financial risk. For example, if debt is high, we consider the financial risk to be high. So it doesn't make sense for us to take a beta that is talking about somebody else's debt and equity structure. So what do? We de-gear the proxy beta, we remove their financial risk, and then we re-gear that beta. Okay, we re-gear the beta to reflect our financial risk, and we come up with a new equity beta. Okay, now this new equity beta, we can use the CAPM equation and get the cost of equity, and that cost of equity will be a better representation of what actually is going on in our business. Okay, so if you don't have even a basic idea of what I was talking about, what I said will not make sense. But if you have a basic idea, you should be okay with what I said. Okay, so we'll start the next question at 8:30. I will take about 4 minutes just to talk about what I said right now in a more basic sense. Okay, but what I said right now, that is what you need to say for these 8 marks. Okay, right. So what am I trying to say? There are 4 types of risks that you should know about. One is unsystematic. One is systematic. One is business. One is financial. These are 4 different types of risks. Okay. What is unsystematic risk? Now, this is the type of risk that is specific to a particular industry. So, for example, if you are in the umbrella industry, anyway, you have a problem if it is not raining. Okay, if there is no rain, then anyway, your profits will drop. Okay, so we say unsystematic risk, almost all types of unsystematic risk, you can reduce as much as possible by investing in different businesses. So, for example, if you go and invest in something like sunglasses, now sunglasses, when it's raining, of course, umbrella, when it's raining, it will increase, right? Because people will want more umbrellas. Sunglasses, on the other hand, when it rains, the sales will drop, but when it's sunny, it will increase. And at that time, the umbrella will reduce. So when one increases, when the umbrella sales increases, sunglass will reduce. When sunglass increases, umbrella will reduce. So unsystematic risk, you can, to a very great extent, you can reduce it by investing in different businesses. That is unsystematic risk. Systematic, on the other hand, is something like the recession of the country, or the country is in a boom, economic situation of the country. Now, if you're in a recession, whether you're in umbrellas or whether you're doing sunglasses, anyways, a drop in sales is going to happen everywhere. So, by diversifying or by investing in different businesses, there is no way where we can reduce systematic risk. Systematic, you have to face it. Okay. So, if the systematic risk is high, then the return that the investor, the equity investor, they want, that will also be high. Systematic risk is high means they are taking a higher risk, so they will expect a higher return also. Okay. Business risk is also similar to unsystematic risk. So what is this? This is to do with that particular type of business. Again, different industries will have different problems. Right? For example, if you are in umbrellas, you will see one problem. If you are in sunglasses, there will be another problem. If you are in mobile phones, you might see another problem. So, business risk means, again, risk specific to the operations. Okay, it's specific to the operations, it's specific to that particular industry. Financial risk, on the other hand, is to do with your debt equity structure. Okay, financial risk is to do with your debt equity structure. Okay, what we are saying is if your debt is high, okay, if you have really high levels of debt, then what is going to happen? You're going to be perceived as a very risky entity, because in case something goes wrong, you will default on interest. If you default on interest, you can even be asked to liquidate. Okay, so if the debt equity structure, obviously from company it will keep changing, right? For example, company A, they might have 60/40. Company B, they might have another structure, 80% debt, 20% equity. So for every company, this will obviously keep on changing. Okay. Now in this CAPM model that we are talking about, what is the equation? If you remember, the cost of equity equals the risk-free rate plus the beta equity. It's equity beta. I'll talk about that in a bit. Minus RM minus RF. RM is the market return. Here it's the risk-free rate of return. So what does CAPM say? It says that we make an assumption. What is the assumption? We are assuming that all our investors are diversified. They are properly diversified investors. So that means through their diversification itself, they have already dealt with unsystematic risk. So the unsystematic risk will not affect the cost of equity or the rate of return that the equity holder wants. Okay, because he doesn't care whether it's going to rain and umbrella sales will rise or not, because already he has another investment in sunglasses. So we don't have to worry about unsystematic risk at all. This cost of equity, it will depend only on the systematic risk. So like I said, if the systematic risk is high, you will see that the return that they are demanding also will be high. Okay, so that is the CAPM. Now this beta equity also has a story. So let me quickly talk about that as well. Now when we talk about betas, there are two types of betas. Okay, so let me write beta. One is called a asset beta, and the other is called the equity beta. Okay. Now what is asset beta? This beta, it reflects only the business risk. Only the business risk it will reflect. Okay. And what is the equity beta? It will reflect both the business risk and the financial risk. Okay. So what do we put in the CAPM equation? We put the equity beta only, because we have to consider both business risk and financial risk. Now, why are we saying that when you're using this CAPM module, it's going to be good if you're investing in a new type of business? The thing is this. For your company, you will somehow have a beta equity. No problem. Let's say, for example, we are selling cars. Okay, we are selling cars. So we are anyway going to know what our beta equity is. We will know the business risk. We will know our financial risk. We will put it together, get a beta equity. No problem. And using that beta equity, you can get cost of equity also. No problem. Fine. Now let's say this car business, we want to, go and invest in another area. We are interested in something like solar panels now. Okay, now there is a demand of a solar panel. So now we are going to get interested in solar panels, and we want to see how, what will be the return that our shareholders will ask if we are going to diversify into that particular business area. Now, the thing you have to understand here is, when we are talking about a completely new area like solar panels, we can't use our car beta equity and calculate KE. It doesn't make sense. Why? Because the business risk for cars and the business risk for solar panels are two very different things, two very different businesses. Okay. So what we can do is, we can go look for a company who is already in the solar business. And what do? We take their beta equity. Because now in the solar business, that beta equity, it will reflect the business risk of solar businesses. Okay, but their beta equity will also at the same time it will reflect that solar company's financial risk. Okay, now that doesn't have to be the same as ours. For example, our company, we may be having debt 60, equity 40. The solar company must be having debt 80, equity 20. So we can't just use this beta equity of the solar company because the financial is different. So what do? We de-gear. De-gear means we are removing the financial risk from the beta equity. Okay. So when we de-gear a beta equity, we get what is called only the business risk portion, that is the beta asset. Now this beta asset, it's talking about business risk in the solar business. So what do? We take this beta asset. Okay, so we have the business risk now. We take the beta asset and we re-gear it. Okay, so the beta asset, we re-gear it. So what do? We add our financial risk. Our financial risk, that is 60/40 now. We add that into the beta asset and we get a new beta equity. So this new beta equity, it's reflecting the business risk of solar panels and the financial risk of our company. Okay, because now this is our company. So this beta equity, you can put it into the CAPM equation and get the cost of equity. Suppose you are going to invest in solar panels. Okay, so you can see the new beta equity, it talks about business risk in solar because we took it from a solar company, but we are not talking about their debt equity structure. We can't talk about theirs. It doesn't make sense. Theirs was 80/20, ours is 60/40. Okay, so we remove their 80/20. That's called re-gearing, and we add our 60/40. That is called re-gearing. Okay, so now we have a new beta equity which talks about solar's risk and our company's financial, which is 60/40. Okay, so this is basically the advantage of being able to use the CAPM as opposed to even dividend valuation model, because here you can calculate cost of equity even if it is a completely new investment. Okay, so one last thing, how do you do this de-gearing, re-gearing? There is an equation for that. Where is that equation? Here. Beta asset equals the value of equity over the value of equity plus value of debt times 1 minus t into the beta equity. Okay. And you can, for the purpose of FM, you can always ignore this second bracket because we always assume that beta debt will be 0. Okay. So for this paper, you don't have to worry. You can just cancel this second bracket off to calculate beta asset. So this is the de-gearing. You would use this formula. Even re-gearing, you'll use the same formula, but the equity debt ratios will be different. It will be our company's ratios. Okay. Right. So if you can say all of that, I know it's a lot to say, you would have got 8 marks. Okay. So let me quickly show you the marking scheme as well for you to understand. 449 means, let's try 475. So 449, yeah. So look here, it says, just look at what is highlighted, okay? The CAPM model assumes that investors hold diversified portfolios, so unsystematic risk has been diversified away, okay? So the return, okay, therefore the CAPM companies using the CAPM to calculate project-specific discount rates are concerned only with determining the minimum return that must be generated by an investment project as compensation for systematic risk. So we need to only consider the systematic risk. It's useful where business risk of an investment is different from the business risk of the investing company's existing business operations. Okay, so what do? We take the equity beta of a proxy company representing the systematic risk of the proxy company. That beta is de-geared to remove the effect of its capital structure. De-gearing converts the proxy company's equity beta into an asset beta, which represents the business risk alone. The asset beta can then be re-geared, giving an equity beta whose systematic risk takes account of the financial risk of the investing company. Okay. The project-specific equity beta resulting from the re-gearing process can then be used to calculate a project-specific cost of equity using the CAPM. So if you can, there are enough and more points to make here. If you can make 8 of those points, it's an easy 8 marks. Very easy 8 marks. Okay, see, ungearing proxy companies equity beta, you get 1 to 2 marks. Averaging and re-gearing asset beta, you get another mark. Project specific cost of equity using CAPM, got that. Project specific WAC, appropriate reference to business and financial risk. If you can make any point to do with all of those steps, they were basically a series of steps. So if you can make any point for those steps, that will be more than enough for you to get the 8 marks. Okay, right. Okay, so I said that we will do 3 constructed response questions, but I don't think we have time for another constructed response. So let's do an MTQ. Okay, so let's do an MTQ, but that will also be based on investment appraisal because that is the topic that we wanted to do. This will be Bell Company, page number 68. Okay, page number 68. So I'll go there quickly. I wanted to do a longer question, but in 20 minutes, I will just have to rush through everything. So no point, let's just do an MTQ. Okay. But guys, what you got from the TRG today is all important areas. Okay. Because had we not done it in this TRG today, then what could have happened is when you're practicing it, you might not have understood what's going on. Okay, so that's the reason why I chose these questions, especially the WAC, because you will see all the WACs, they never use the WAC equation. So you shouldn't get confused why that's the case. Okay. Right, so let's go to page number 68. This is a company called Bell Company. Let's try it out, okay, quickly. Yeah, this one. $96. Okay. It says here, Bell Company has decentralized and divisional managers. Okay, they have decentralized. That means different departments can take their own decisions. Okay. And obviously, the people who take the decisions are called the divisional managers. So it says here, Bell Company has decentralized and divisional managers are allowed to make their own investment decisions subject to confirmation by the main company board. So you have to get confirmation from the board. Because each of the 3 divisions, Ding, Dong, and Merrily, okay, so it's something to do with bells. So Ding, Dong, and Merrily are subject to different levels of risk. It has been thought appropriate to use different rates in each division. Okay, so they're trying to use different discount rates in each division because the level of risk is different. Ding has been told that its real discount rate is 5%. The general rate of inflation based on an index that it uses a very wide range of prices is 2%. So general rate is 2%. In the industry in which Ding operates, a number of prices are seen to be inflating at 3%. So that's a lot of information. But what they're saying is real rate is 5%, general rate is 2%, and the inflation rate is 3%. Okay. So that's about Ding. Dong is assessing a project in which the first 4 annual lease payments has been agreed at 120,000. This is payable in 1 year's time and subsequent payments will rise by 4% per year. Dong's proper money cost of capital is 8%. So it's a lease payment, maybe a lease versus buy decision. Merrily is considering investing 1 million in a project which will produce the following annual outflows and inflows. So we have outflows, we have inflows. The cash flows which arise at the end of the year are stated in current year terms. Okay, this is current year terms. It is expected that outflows will rise by 3% and inflows by 2% per year. The money cost of capital of Merrily is 9%. So we have 3 different scenarios, 3 different areas of investment appraisal. Okay. First one, A part. What is Ding's money discount rate? Okay. So we have been told that their real discount is this much, general inflation is this much, and In the industry in which they operate, a number of prices are seen to be inflating at 3%. Okay. Sorry. So if we have to get the money discount rate, we have to use this equation called the Fisher formula. It's also given to you. Okay, so let's copy it here. This is the Fisher formula. So what is this Fisher formula? 1 plus the money rate equals 1 plus the real rate times 1 plus general inflation. Okay, it's 1 plus H is general inflation. Okay, so if you're using, you should use 2 because that is only the general rate of inflation. So they're asking for the money rate now. So that's going to be 1 plus I should equal to 1 plus the real rate, which is real discount rate is 5%, times 1 plus the general rate, which is 2%. So careful, don't use 3. Okay, we don't take the industry rate, we take only the general rate. Right, so that's that. Let's put it in the cal again. Don't ever try to rearrange and do all of that. Put it as it is, okay? So 1 plus the answer should equal to 1 plus 5% times 1 plus 2%. Okay, shift calc, solve it. So that will be 0.071. So as a percentage, it is going to be 7.1%. Okay, 7.1%, which is A. Money discount rate, simple. Okay. What is the present value of Dong's last payment that will be made in 4 years' time to the nearest $1,000? Okay. So let's see what is happening to Dong. Okay. Let me draw like a timeline to make things clear. So it's saying Dong is assessing a project in which the first of 4 annual lease payments. Okay. So there will be 4 payments of 120. There will be 4 of this. So let's have 4. Okay. This is payable in 1 year's time and subsequent payments will rise by 4% per year. Okay. Now in 1 year's time means today it is what? Year naught. So the first payment is going to happen in year 1. And the next one will happen in year 2, then year 3, and then year 4. Okay, so these are the payments. Now what are they asking you? They are asking you the present value of Dong's last payment that will be made in 4 years' time. So they are asking you the present value of this payment. Now, first of all, you have to inflate this payment because they are saying every year it will increase by 4%. So year 1, it will be 120,000 into 1.04. Year 2 will be 120,000 into 1.04 squared. 120,000 into 1.04 cube. And in year 4, the payment is 120,000 into 1.04 to the power 4. Okay. So that will give you, the value will be 134,000. Okay, 1 second. 1.04, 1.04 2, 3, 1 second. I'll just check if it's 3 or 4. Yeah. Sorry, there's a small thing. This is year naught, right? Okay. So in year naught, we are not making any payment. 120,000 is not happening in year naught. So year 1, there won't be an inflation. Okay, so that will be just 120,000. Then year 2, it will be 120 into 1.04. Okay. Then here it will be 120 into 1.04 squared. Here it will be 120 into 1.04 cube. Careful, right? These are the errors that we can make. Because usually they say in current terms it's 120. So from year 1 itself we will start inflating. But here the first figure that they give you itself is in year 1's term. So you don't have to inflate the first figure. You only have to start inflation from year 2. Okay. Right. So 120,000 into 1.04 to the power 3 will give you 134,984. Okay. So this is the cash flow. They are asking you for the present value. Okay. So present value means you have to multiply it with the discount factor at what is the percentage? They're saying the proper money cost of capital is 8%. So at 8%. Okay, at 8%. How many years? But careful, right? We inflated it only for 3 years, but when we are discounting, you should discount it for 4 years only. Okay, because it's a payment that happens in 4 years' time. So how much will that be? It will be 134,984 into discount factor at 8%, 4 years is 0.735. So this should be 99,213. So they say to the nearest 1,000. So you can just say 99,000. You don't even have to say 99,000. You just have to type 99 here because already the thousands are given. Okay. So that's a simple one. C part. What is the NPV of Merrill's project to the nearest 1,000? So where is Merrill? Okay. Merrill is considering investing 1 million in a project which will produce the following annual outflows and inflows. Okay. So we have the outflows. Okay, that is 1,800, 2,500, 1,500. Inflows also given. Cash flows which arise at the end of each year are stated in current year terms. Outflows will rise by 3% and inflows by 2%. Every year it will increase by 3% and 2%. The money cost of capital of the Merrill division is 9%. Okay. Right. So let me first set up the table for NPV. They're asking for NPV now. So here not 1, 2, 3. Okay. Right. So we have the inflows. How much is that? Year 1 it's 2,000, year 2 is 3,000, and year 3 it's 2,000. Okay. Then what are they saying? The inflows, it will be inflated by 1.02%. Right? Inflows are going to get inflated by 2%. Okay. So this will be 1.02. Here it will be 1.02 but for 2 years. Okay. So I'll just write the inflation over here and then I will just formulate it to inflate it properly. Okay. So every year it has to increase by 1.02. So then inflated inflows. Here it will be 2000 into 1.02 which is 2040. Here it will be 3000 into 1.02 squared. Okay. So 3000 into 1.02. I'll square it. That is 3121. Okay. Careful because the inflows are different. You can't just, just use one rate. So here it will be 2000 into 1.02, but this is the third year. So you have to cube it. Okay. So let me do this. Let's just do it for a whole number. 3121 and 2122. Those are the inflows. Then let's do the outflows. How much was the outflows? 1,800, 2,500 and 1,500. And we need to inflate them as well. Inflation for the outflows was 3%. So 1.03. Okay. Right. So inflated outflows. Okay. That will be, here is straightforward. Okay. But here you have to be careful. You have to square it. Okay. Here you have to cube it. So again, let me take it as whole numbers. Okay, so 2652 and 1639. So those are the outflows. So now we have the outflows and inflows that we need for the NPV calculation. So let's take this separately. Right. Okay. Paste the numbers. Just make things easier. I'll just copy it. 2652 and 1639. Get it to the nearest whole number. Yeah, the other thing is, guys, those of you who are used to doing it with spreadsheets, do a few questions without a spreadsheet also, right? Because now, for example, this is an MTQ. You won't have a spreadsheet at your exam to do this. So you have to be able to do this manually, by hand. Okay. And those who are used to doing everything by hand, practice with the spreadsheet also, because section C, you need to be able to do it with a spreadsheet. So be comfortable with both. Okay. Just the spreadsheet is not enough. Just manual is also not enough. But manual, if you can do it manually, you can at least survive the spreadsheet. But if you don't know to do it manually, then the MTQs, you don't have anything to help you. Understood? Okay. So then we have the, okay, let me take this to the other column, because we need to have year naught. No? So year naught, year 1, year 2, year 3. Then we need to put the investment. How much was the investment? They say it was 1 million, but we're doing everything in thousands. Okay, so at the top itself, say thousands, okay? So we can say the investment is minus 1000. Okay, right. So finally, we can get the net cash flow because we have everything that we need for NPV. Okay. Right. So now we have the inflows and the outflows. So inflows minus the outflows. That will be 2040 minus 1850. So that is 186. So you have to get that for all the 3 years. So 186, 469, 483. This is the net cash flow. You have to discount it using the discount factor at how many percent for Merrily? Money cost of capital for Merrily is 9%. So at 9%. So year 1 will not will always be 1. Then 9% for year 1 will be 0.917. This is the discount rates, right? You have to use the present value table. And 0.772. Then we have the present values. So this will be minus 1000. This will be, sorry. Okay, so 171, 395, 373. So the NPV, which is the total, will be the sum of all of this. Okay, this plus this plus this plus this. Okay, so that will be a negative 61, which is D. Okay. So again, now for example, this particular question, It's actually easier to do it by hand than this. Okay. So, and I mean, I'm sorry, not that it's easy. Obviously, it's easier to do it by spreadsheet than hand. But you will have to be able to do it by hand because you won't have access to a spreadsheet for MTQs. Okay, so I know it's easier this way. It's easier to inflate and all, but still, unfortunately, you don't have a spreadsheet for MTQ. So be mindful of that. Right. D. When considering risk in project appraisal, what is the main advantage of using simulations to assist appraisal? Okay. So simulation means basically where you can change different variables. Okay. And see what will happen to the final outcome. Okay. So if you remember sensitivity analysis, there was a problem where we can only check the sensitivity of the NPV to one particular, variable that's changing, for example, sales or volume or something like that. Simulations, we can see what will happen to NPV when different factors change. So definitely not a clear decision rule, okay? Decision rule clear is something to do with NPV, IRR and things like that. Simulation sensitivity, we don't have a clear decision rule. More than one variable can change, that's true. Statistically more accurate, no, okay? Because these are just forecast. Being diagrammatic is easier to understand. Simulations are not based on diagrams. Okay, so it's again done using spreadsheets alone. So the answer is B. Okay, so basically what you have to know about simulation is, in sensitivity analysis, we see how NPV will change when one factor changes. Whereas with simulations, we will see how NPV will change when more than one variable changes. So that is the advantages of simulation over sensitivity analysis. Then we have E part. Is it possible to have a negative real discount rate to apply to the cash flow estimates made in current terms when making investment decisions? So they're asking you here. Now, for example, we did Fisher equation here. They're asking, is there a situation where this real rate can be negative? Okay. The answer to that is yes. Okay. The reason is it will happen if the rate of inflation, okay, this inflation rate H, if it increases or if it goes more than the money cost of capital. So you can just put random figures and see. For example, put the money cost of capital of as say 8, and if you put general inflation as 10, you will see that this real rate becomes a negative figure. Okay, so the answer is yes, it will happen if the rate of inflation exceeds the money cost of capital. Okay, right. So that's it for the day. I will see, let me see who is here first. Yeah, you too. I will see you guys on Saturday with the mock. Try to come. Yunus also try to come on Saturday at 9:30. We will have the mock. I will mark it and come back to you on Sunday. Okay. Meanwhile, as far as the TRG goes, we will continue with the same pattern. The next 2 weeks, we will do a little bit of working capital management. I won't focus too much on risk management after this because we have done enough and more money market hedges and forward market hedges. So we will focus on the other areas, that is working capital management, investment appraisal, cost of capital and business valuation. Okay, because risk management, for one thing, I don't have many questions also. The other thing is, although it's a little complicated, there is only maximum about 8 to 10 marks that you can talk about there, if you're lucky. Okay, if you don't get a money market hedge, then you don't get it. So that's why I don't want to focus too much, but I hope by this point, you're good with money market hedges. I hope that's not bothering you anymore. Okay. So yeah, I'll see you all on Saturday at 9:30 as far as the TRG goes. Yeah, so since there is nobody from outside, but in case they're watching the recordings, as far as the TRG goes, we will have the next class next Tuesday, again 6 to 9. Okay. So yeah, have a productive week and yeah, good luck studying. Okay. No problem, Shan.